Believe it or not, we can do a quick first pass underwriting on a deal in literally like 10
When you
minutes.
invest in a property, don't stop investing. Just because you bought it, that's not an investment.
All the
Investing is
brokers
investing.
lie and misadvertise. No, not all of them. Some I look and they have very reasonable rent assumptions and we use it.
Hey everyone, welcome to Multifamily Mastery, Unlocking Wealth with California Real Estate. Your hosts are Bill Mulkey, owner and founder of TR Wealth Management, and Dwayne Lappinga, director of asset management. Hello, everybody.
Hi, how you doing today?
Hello.
I'm good. So for those of you that don't know, I'm producer Rachel. I am their producer. And today we are going to do a panel. The episode is aimed at providing the listener with tools and best practices for underwriting real estate investment deals. We're going to be focused on educating everybody about the right way to underwrite. Yes? Are we all good? We're on the same page?
We're good.
Yeah. We're
All
going to try
right,
to
so-
make that exciting if that's possible.
Underwriting is so exciting. We love underwriting.
Yeah, it's underwriting for the purpose of making money on your investment, not like an insurance policy for somebody, whether they're going to pass away or not. So it's good underwriting.
100%. Exactly. All right. So, Bill, I am going to start with you. We're going to go back 23 years to your first deal. How did you actually handle underwriting?
Wow. I've got to go back a long time. Basically, I actually, to be honest, did everything on one page. I was able to put together the numbers, which would be the rents for the property, the income and expenses, and maybe some loan assumptions, which are actually maybe sophisticated when you first start. But basically, I put them together on one page to see the snapshot in time of what the property is worth. What's it selling for on the if you're buying apartment units, which we do, how much is it per unit? Because a house, $1 million, and one unit, it's $1 million for the house. Two units, duplex, it's 500,000, so on. So the cost per unit would be that. Maybe the GRM, the gross rent multiplier. There's some terms that maybe not everyone knows, but we can go over that later. And these terms tell you the cost per foot, not too hard, how much you're paying per foot. And you compare that to other properties. And that's what I did is I used one page to look at my indicators. And then I looked at whether the property was going to make sense or make cash flow or not when I bought it. And that would be in one column, the current situation. And then the other column, I would just have the market rents. And you see a lot of these setups today from brokers where they're making up the numbers. Caution you on that is that they're making up the numbers in order to sell it. You need to make up the numbers or at least trust but verify those numbers to make sure that if I did the work myself, I knew what everything went into it. And it's like building a house, right? Everything that you build, if you do it yourself, that's great. It takes a long time to do. That's part of what we're going to talk about today is using one page to evaluate the property, what it'd be worth as far as on the buy side, on the buying it.
Okay. So then moving forward, how many deals did you complete in this way? Did anything change over those first 10 years?
Yeah, there were some changes. Basically, I realized that on the side, in the back, in the file, I'd have the sales comparables. How do you find those? You either find them from your broker, you find them from other people that send you properties that they're saying what has been sold. You look on different databases. Some of these cost money to provide, or you've got to use a broker or maybe even a title company. A lot of people are familiar with title company. You can get comps from them, but they're just like the address and what it's sold for and how many square feet it is and maybe how many units it is. Doesn't really tell you all the income data. That's got to be researched one way or another. And your broker and your lender should be very helpful in that. But the way I graduated is after about, I'm talking 5 or 10 years and a lot of deals, I had to make a second page because I had to show people what we could sell it for. So one was the buy, one was the sell. It sounds so simple, but a lot went into it. And what became the problem was I had to sell that to other people and I had to prove it up. So that's why I had to grow in what I had to produce. So I did come along for that.
Okay, so then Dwayne, you started working with Bill about 10 years ago. So how did you start underwriting deals?
Sure. So that's about 13 years into Bill's process. During those 13 years, we're neighbors. So we're actually seeing each other passing by or soccer games or whatever, but we weren't working together yet.
So you were in each other's sphere of influence, right? Isn't that kind of
Yeah.
what real estate agents call it? You were in each other's sphere of influence.
Yeah.
Okay.
Yeah, exactly. And I was working a corporate job in real estate, but I was doing more property management and engineering type stuff for buildings. And then so 2013, that was 13 years after Bill had started his business. I was in between jobs and I was working a contract. That particular contract required me to work from 6 a.m. in the morning until early afternoon. Then every day I'd go to his office and hang out, and I think he thought I was just kicking the tires on his operation because I was thinking about investing. But we started looking at deals together. And really, Bill taught me the basics of how to underwrite a real estate deal. I already knew how to underwrite other types of projects, for instance, energy conservation projects for buildings. So it wasn't too hard to adapt. And interestingly enough, in those afternoons of, I think it was a couple months that went by, and I was there almost every day, we bought two of the deals that we did underwriting for during that time period.
So were you thrown into it, but you had a basic understanding of what was happening, right?
Yeah, I had actually taken real estate classes on all the terminology. Again, that was to support my career as an energy engineer for buildings, and you had to understand the economics. So it wasn't that unfamiliar. Bill knew all the things about here. Here's what a cost per square foot should be. Here's what percent your expenses should be. All
Well, that
that
brings me
stuff.
to Bill. Like, Bill, what are some of the key assumptions made during underwriting?
Yeah, I want to try to give the basics, and nothing is ever absolute in any situation, in any deal. Every deal is totally a living, breathing thing from start to finish. Even though you're talking about bricks and mortar, remember you're talking about tenants too, and those are real people, real lives. So there's a lot to it. But basically, one of the formulas that is very common practice is your lender or your mortgage broker will use an appraisal for the bank. The appraisal is to protect the consumer, but it's really also protecting the bank. They're lending the money. So they're going to be conservative. They're going to make sure that all the expenses are included. So if you use bank figures rather than broker figures, you're probably going to have a more conservative approach. And that's what you should do when you're buying, unless you really know what you're doing. Unless you really know what you're doing. I can cut corners and do things and make things work. But overall, I know that in our area now, every area is different, so it's not absolute. I use a minimum of 5% vacancy and 35% expenses to operate a 1960s, 70s, 80s building or more as just commonplace. And all that means is just figure it out. Vacancy is several things. It's people, it's a vacant unit, it's absolutely nobody in it. There's somebody in it but not paying, and there's time to remodel it or get it ready or clean and show and rent it. So that's going to be some financial loss. You can't just accept what the full building is as your income. You have to have your gross operating income, which is taking out the vacancy. Then the next thing you have to do is you have to assign expenses. The best thing to do is just get those expenses from the landlord. A lot of people have it on the back of a napkin. If you're going to accept that, then you're trusting the seller a little too much. You need to verify it, inspect but verify. So when you use those two costs, 5% for vacancy, it's taking off your income, and 35% of your expenses coming off for income. And of course, you have to adjust for building types, ages, areas, locations, collections, everything. But just if you could use that for the benchmark, you're going to have 60% of your income. So if you have $100,000 of income, just use 60% of it, or take 40% off to make 60%. So at 60% of $100,000 is 60,000. That would be your leftover net operating income. And that would be the money left over to pay your loan if you have any loan. If you don't have a loan, then the $60,000 would be your annual income. And if you want monthly, just divide by 12, $5,000 a month. This is going to be producing.
Oh my goodness. That's a lot. That's
Yeah,
crazy.
no. Visuals help. Visuals help. We'll have some
Mm.
strategy meetings on that, and we'll actually have it up on a board to show people. It was probably quite complicated, that explanation. But once you get down to the nitty gritty and really memorialize your expenses, they're going to ebb and flow, and you need to watch them. But once you have that, the lender can determine, and they'll show you, if you spend time with your loan broker and get them to tell you, they will actually tell you what appraisers are expecting for normalized expenses, what your
Okay.
expenses are, and what the bank sees as value best based on a debt coverage ratio, which is another item, but it just means how well you'll cover the payments. They want to make sure you can make the payments. So that's why
Okay.
they're conservative, and that's what that's what appraisals do, is they help people with that process to make sure they're not overpaying.
Then that brings me to Dwayne then. What kind of software tools are you using for underwriting?
Believe it or not, it's still Excel. When Bill and I were first putting this together, we had an Excel workbook with 15 sheets in it, and we were entering numbers all over all 15 sheets. And then we were trying to remember, oh, we changed that number on that sheet, so now it doesn't match. We got to change the other 14. And I said, this is insane. And so, believe it or not, I was sitting in a library between water polo tournament games for my son, and that's when I said, I'm going to rebuild it. And I sketched out, okay, we're going to have a data entry form. All the data entry goes there, output on all these sheets. And then I built some stuff in Visual Basic, some macros and things, and all kinds of if then statements to make it into sort of a piece of software, even though it's still Excel. And by the way, we are in the process of migrating this to a web application, but that's still months and months away. All the methodologies there in Excel. We do have a pretty good workbook to the extent you can do anything in Excel.
This is why I love Dwayne. Like Dwayne has a problem solving brain. Like I have that same brain too, where it's like you can take a problem and I'm not going to keep doing it the way that is inefficient and not working for us. I'm going to solve the problem and make it work for the business and make it work for your clients, for your team. I love that.
That's
Yeah,
Oh,
go
go
ahead.
ahead,
Sorry.
Bill. Oh,
No, I was
okay, I'll
just
go.
I,
I'll
go
go.
ahead.
I'll go. So that was my mission when I was hanging out in Bill's office those first few months is I'm like, I need to capture all this brilliance. This guy knows how to do real estate deals. He knows how to make tons of money on them, but it's all up here, everything. And it's we got to get some of this down in an organized format that we can use it. So
I love that. Then
Yeah,
that brings
very
me
true.
to we love Dwayne, that Bill. That big Bill, that brings me to you then. So then what are some potential pitfalls that you see in underwriting? Because it seems like a complicated process that you guys have tried to refine, right? But what are some of the pitfalls?
The pitfalls are exactly what Dwayne just outlined. And just going backward just for 1 second, because I do want to comment that couldn't do it without him. Have everything on the brain. Very hard to communicate with somebody, one investor at a time. As I grew from one investor to two investors to four investors to five investors to more, I'm repeating the same things over and over again and getting the different 150 questions that each investor asks to the basics. How's my money doing? Or just somebody who wants to buy their first property, show me how. I told him if I could take 40 years of business and take it out of my brain and put it into a book, great, but you just don't have all my experiences. So it's just too hard to just gel in to do that. So that's why I'm doing a little on these podcasts and webinars and try to give it away as best I can. But again, the pitfall is what I fell into. I knew it, but I couldn't communicate it very well. I couldn't always think about what I wanted to say when I wanted to say it because I'm anticipating my next question, or maybe just I'm trying to put out fires because after I bought 1, 2, 3, 4, 5 properties, guess what? I still got to take care of those babies. So I'm taking care of these investors and working on those investors. I had to build a team. Without Dwayne, I couldn't do all of this macros and all this. Come on, I don't even know what those are hardly. You know what I'm saying? So the thing is, I knew what to do. I understand them, but you got to understand, I have no idea how many hours Dwayne probably kept track, but after 10 or 15 years of working with him, or maybe it's 13, it feels like 150 because we did a lot of hard work. There's so much that goes into each line item that we actually both look over to double check each other's work and say, is that really the right number? Is that really going to happen? And of course, you never really know what tenants and what the market's going to do, but we really try to mitigate all our problems. So getting into what the question was, is that what pitfalls? The pitfalls are not having a good system, not going over to every line item, not getting the data from the seller, not getting the data, just accepting the data without inspecting it. So you have to inspect what you expect. I learned that from one of my mentors that I worked with in a large brokerage company. You can get the data, but you got to inspect it. Just because they tell you the guy pays $500 for rent, does he pay $500 for rent? Does he pay it on time? That has to do with your vacancy factor. We just talked about the vacancy factor. If the people aren't paying the rent on time, then you better have a higher collection loss, which is vacancy factor. So that's just one thing. There's millions of other things. What if one bank you went to says, I don't like that property. I don't like you as a borrower. I want somebody richer, and I'm not going to give you a loan. Where are you going to go? You got to go to the next one. Or they say, we'll make you a loan, but it's 9%, and somebody's willing to do it at 7.5%. When you're ready to have a lower loan? Yes. So you have to work so hard to get these relationships. You have to work so hard to look at the data. You have to actually open the horse's mouth and look at it if you're going to buy it. And you got to go down and look at the property. You got to get a little dirty. You got to roll up your sleeves. I have my sleeves rolled up on purpose. I don't want to look all like I'm an investment banker. We have to get dirty in property management. We're an alternative investment. We can affect change in our properties. We're not just a stock that you're buying. And that's where I can make all the value. A good partner and a good broker and all these people that we use for tools will really affect your value. But you've got to, and if you want to do it everything yourself, you can try it. It's just, you got to do it. You just got to understand it's a lot to do.
That brings me to Dwayne then. Have you learned any lessons from underwriting deals? What are your biggest lessons from underwriting deals?
Sure. This actually goes all the way back to modeling energy deals for buildings back in the early 2000s, and particularly on-site generation of electricity or air conditioning optimization, where you spend a certain amount of money and then you get all this energy generated, or you spend a certain amount of money and then you save. Your electric bill in a commercial building can be $50,000, $60,000 a month and on upwards. So it's a major financial consideration. But you go look at the building, you study it, you have an idea for a project. You want it to work, the numbers to work so bad that there's a huge temptation to start pushing your assumptions to make it work. And I learned that kind of the hard way back before I started doing these things with Bill, and running the same thing on these real estate projects. We find a building we've always wanted to own in this suburban community, and there's all these great commuters. It's by the freeway and it looks like a good price. Run the numbers and it's just not working out. You have to hold yourself back from saying, I'll push the rents beyond what market rents are because I hope that we can do it. And we stop each other from doing that. That's why it's good to have two people. But I've also learned to just shut it down. If it's not working with standard assumptions that would be accepted by an appraiser, by a lender, even by brokers, if they're good brokers, you probably need to park that deal. Who knows? They might not sell it. You come back to it at a price that's $250,000 less in a year. Then you buy it. So this is where underwriting gets to be super valuable, giving you that kind of steering on the deals you chase after.
But yeah, sometimes it's just not meant to be. And a lot of times, maybe just by saying no allows space for something better to come along. You can't be scared to walk away sometimes, right? So you've proven that underwriting is important. So you've proven that underwriting is an important process. But I want to ask Bill, like, when do you perform the underwriting task? Is it first when you find a building? When does this happen in the process?
That's such a good question. Oh my God. And I have to again use
Hey, who wrote these questions? No, sorry, go ahead.
Let me tell you, this is a great question. Can you believe I have some versions, 30 and 40 versions of the same property before I close escrow?
Oh my gosh.
I'm manic and he's panic because I panic him. Like, really? We're going to do this again? Yes, we're going to do. I'm like a taskmaster. I'm supposed to be not so boring, but I'll tell you, I just got to have it right. And you know what? I walk away from a lot of deals. And honestly, I've learned no is the biggest time saver. Just what you said, Rachel. Just what you said. And I just want to let you know that I still use an HP 12C.
That's
Yes,
a calculator. Like a
some
real
old people,
calculator.
some old people might know this. There's some formulas on the back that you might find useful, like how to calculate a payment and things like that. But there's my geek part right here. I have a geek part of me. And anyway,
My gosh, I love it.
very important to do. So I think that the biggest thing that I think that Dwayne hasn't said today is that he worked for very large real estate corporations, REITs, things like that. That's real estate investment trust. And these guys are big and they know what they're doing. And they have a lot more property than I've ever owned, managed, or even sold or looked at. And he's learned a lot from that culture. GE Capital, I'm just naming some names, but And I think that's why he knows so much about real estate and the language. And he worked in property management for the largest real estate firm there is. So he's such a tremendous asset. Why do you think he's here besides me? I'm no dummy. I see a good one when I can pick a good one when I see one. And I also pick a very good deal when I see one. And I want to buy these deals too. You're right. But I have no pressure from a large corporation that's giving me billions of dollars that says you have to place them right now. I never wanted that. I still don't bring me that money. I don't want it because that's pressured money that I got to make bad decisions and make it work. I don't force myself. I can go 6 months without buying a deal. I can even go a year if I had to. A lot of investors do that. But if they're a company that only solely relies on that, then guess what? They're gonna start bending the rules to get the deals to work. And that's why a lot of people have been in trouble with real estate when it adjusts. And one other thing about underwriting that I didn't discuss is having a good reserve to take care of the properties that the things in the properties that may come up or things that you might have missed because you can't x-ray the building and look it through the walls. Things happen and you need to have a reserve to do that, and you have to have a good feeling for what to do. And the owners books and records for the last year or two kind of tell you what's going on, and you can sense it. If they're constantly snaking the drains, then guess what? Probably the drains need to be fixed. Blah blah blah. So the point is, it is so much to look for in a transaction, and you just better have a professional inspection. You better know what's going on before you buy more than you can bite more than you can chew, or whatever they call that.
Don't bite off more than you can chew.
Thank you.
All right. So, Dwayne, if Bill is saying there's 30 iterations of this process, how long does it take to fully underwrite a real estate deal?
So with the Excel application we've developed, believe it or not, we can do a quick first pass underwriting on a deal in literally 10 minutes. So we don't hesitate to put it in, especially me. I'm like, Bill starts talking, I'm like, let's just get it in the application and run the numbers and see what it is. So you get a feel right away. Now, to completely underwrite it to the point where people are going to place money in it, that's a pain because you got to do the comps, all the sales and all the rent comps, and really scrutinize them. Are they relevant comps? Was this a building that had a really low price, but guess what? Somebody essentially gave it to a family member, so it wasn't a real sale? Or somebody bought this one with the intent of knocking it down. So that's going to be an oddball. And to try to run that stuff down and then get the comps looking right on a map with the pins on the map and somebody can navigate it, that's very time consuming. So once we get serious about a deal, we do those things. But it works out because we don't spend a lot of time on the deals that aren't looking good. Because it's amazing. That first 10 minutes, you can throw away a lot of them that quickly. And that's where developing our process, we've big time saver. Bill and I used to talk for hours and hours about buildings and then throw them out. Now we throw them out in 5 minutes. So
that's awesome. You've streamlined the process.
Also, want to comment is that I get a comment on something else. Sometimes we put deals together and they don't work, and we go back to the broker and go, "This is not working. Can you help us?" And he said, "You're right. Everyone else is saying it's too high too." I go, well, "What does the owner say?" The owner says, "I'll take this price." Oh, go back to Dwayne, go back to this thing, put in, instead of $2 million, put in $1.8 million. Oh, the numbers look a lot better now. Okay, but I still at $1.7 million. If I buy it for $1.7 million and I don't negotiate any further and I buy it as, is that good? No, they want $1.75 million. Dwayne, does that work? Investors, does that work? Yeah, the comps are showing this. I go drive the building, by the way, before I even make an offer on it. So can you imagine how many buildings and miles that we've driven and looked at the properties and how much paper, we try to go paperless, but how much information we chew up. And I think people don't realize that finding the deal is foremost the most important thing. That's what everybody wants us for. They say, hey, find us a good deal and we'll buy it. But that's more of a brokerage task. We're doing it where we either have an assignment where we have a customer that just really needs to do something. It might be one of our management customers, or it might be a brokerage assignment of somebody we know, somebody we vetted and they vetted us, and we're having a good feeling about them. The best people I like to serve are the people that give me feedback and go look at the property. I remember one client, for 6 months, he kept looking at the property, coming back to me and go, I owe it to this guy to find the right deal. And of course I did. And so, that goes on in our brokerage outfit. But primarily right now, what we're working on is getting more investors together to be more powerful, to have more gunpowder so we can buy properties. And we're doing it right now. We're buying very good deals because everyone's asleep at the switch right now. They think that a 6.5% interest rate market is impossible to deal with. That's because they were doing it when it was easy. They were doing it when
Mm-hmm.
interest rates were 3.5%. Guess what? I'm used to it being hard. So that's why the old pros are around and the newbies are trying to figure out selling something else right now, cars or whatever they're selling.
Yeah, they're running out of California. And
Yeah,
more
that
space.
too. Well, it is tougher in some parts about California and some of our laws, but the thing is, people still want to move to the Sunshine State where they have a job and
100%.
where they have the lifestyle, and we make sure that there's tenants in there to pay the rent on time. That's part of our job too, is our management function. So it's just a lot to think about, and a lot of people outsource it, but they make it sound like easy. Oh, just hire a painter. Oh, just hire a plumber, or just hire a property manager. You got to sit down and have coffee with them and figure out if they're really going to answer the phone. Do they answer the phone after hours? No, no one does. We do. And we have a service for it too. So we're very unusual. We're a step above, I'm telling you.
So, Bill, if you had to single out one mistake that you see the most, what would that be?
I think probably maybe over forecasting rent growth. It ebbs and flows. Overall, in California, we're probably getting 4% a year, and you can count on it over the long period. But sometimes it goes way up, and sometimes it edges down. And after you improve a property and make it really nice, you may not get the same kind of rent bumps, right? Because if somebody moves out and you move the rent from 2,000 to 3,000, you're not going to increase it 4% maybe every year again, because the tenant's going, whoa, that's just too much for me to handle. So you have to just realistically forecast your rents right, your expenses too, and most important too is provide reserves. When you invest in a property, don't stop investing. Just because you bought it, that's not an investment. Investing is investing all the way through it, and adding to it, because again, these are bricks and mortar. They're not a stock you're buying. You have to put money in afterwards, and you could miss things too. So there's several things, to be honest with you. I think you ask any expert in any field, probably if you ask Kobe Bryant how he shot the ball, it's probably more than one thing that he's doing, and it's a lot of practice. Tiger Woods, a lot of practice. I think they visualize and they're so successful is because they've done it 10,000 times more than someone else. And I think that I've done it too, and Dwayne has too, because we've got 40 years combined. We have a lot more, 40 years of experience in real estate and in investing. So that's what it is. That's what it is. Hard to teach everything on one podcast.
So then, Dwayne, what do you find to be the most challenging part of this process?
So I talked about doing the comps, which is getting all those pins on the map and everything's one of my pet peeves, and trying to make it so people can read it and follow it. Another thing is when you get into a real live one that you think you're going to buy, instead of using all of our standard assumptions on this much cost per unit for water and electricity, this much cost per square foot for insurance, we got to go through all the books and records that the seller's providing and true them up with their electric bills. And if it's a small building, some of these owners, they don't have a summary. They have a stack of electric bills, or even worse, they only were able to find 3 of them. So then you have to go through all that. And especially when you're taking other people's money, you have to put the work in to make sure there's nothing hidden there. But my initial assumptions, we were off by about 3%. Didn't make any difference. It's part of the job. Definitely always do it. And then I already talked about when the property that you really want that's just not going to pencil out. Some of them, it is really hard to let them go. You get emotionally invested in these things. Of course, you're not supposed to get emotional about investments, but let's face it,
Yes.
buying a property is an emotional experience for everyone. Ask Bill, he's bought 100 of them and he's still, I want that one.
That's rule number 1. Isn't that what they always say, is do not get emotionally attached to a property?
Yeah. I think the underwriting holds us back. And if you're doing it yourself, it'll hold you back. We're looking at stuff like, okay, let's assume that we refinance in the second year and it goes from 6% interest rate to 5% interest rate at that time. And we switch from principal and interest to interest only. Our model will do all that stuff. If
That's
you're
so
not
neat.
But if you're not doing investment grade, you could look at just your comps. What am I paying per square foot? How's that compare in the market? Drive the building. You could probably underwrite for your own personal use that simply. But we got to the point where we can quickly evaluate scenarios, which is good to do.
That's incredible. So you guys obviously work together on this process, but I want to ask you, Bill, because your brains are a little different, and that's okay. You each bring something to the table, but what frustrates you about the way Dwayne underwrites deals?
Oh, I get to pick on him now. Oh, this is good. Uh, I think that, wow,
Come on,
I
bring it on.
I do a lot of emotion. I do a lot of emotion. I'm a very emotional person. That doesn't make me that I'm not, like I said, a geek with the calculator. And I know intuitively the neighborhoods that I deal with, and I know what people will do and not do. But I don't meet and greet every tenant and know exactly everything about them. And people think that's a very important process. It is, but we don't really. The sellers don't like us to sit there and talk for 20 minutes with their tenant and really get to know the tenant base. But we end up doing that over our relationship being the manager. I think there's a lot of advantages of being the manager. We see a lot of nuances that people want. People are willing to pay more rent if you give them what they want. The old owner would never give me a new stove, and therefore I don't want to pay the rent increase, or I don't have heat because I don't want to hook up the gas. And believe me, I have all kinds of issues like that. And we solve them, and we get on the tenant side. It's right now there's so many things going on with politics that making the landlord and the tenant try to divide from each other. And it's not, it's a relationship, and the government shouldn't really get involved between that. It's just not, it's a private thing. Now, if there's abuses, which there are, then of course they should have a hand in it. But getting back into the question
I
about
know. I was
Dwayne.
like, what does that have to do with Dwayne and underwriting deals?
well
Dwayne's face is
well
so funny.
well
Dwayne's I'm waiting.
I digressed. I think that you have to fly to the lowest level sometimes to look at things. And I think the way I frustrate Dwayne versus he frustrates me is that I have to go into that level and dissect what's really going on to really know the answer. And part of it's psychiatric, part of it's knowing the area. And so that's what's going on.
Okay, I'm going to translate what you're saying because this is what I think you're
Yeah.
saying. You are a very intuitive person, and you can
Yes.
go to a property and use your intuition and say, I say this, I see this. You can see it differently. Dwayne is a numbers guy. He is a numbers on paper guy. And so the way Dwayne works is the numbers say this, but you and your gut is, I know what the numbers say, Dwayne, but I'm telling you this and this is going to work. Is that right, Dwayne? Let's bring it to you. What frustrates you about Bill? Did I get it right?
See, yeah, you're very close, but this is quite a process between the analysis and the emotion and talking to the seller and talking to the investors. So there's a lot of dynamics going on. But Billy, you missed your opportunity to tear into me. I can't believe it. I'll tell you what you do, and then maybe you'll pick on me a little bit. Okay. So you underwrite any deal. If it comes out well and it's got a good return, Bill every time says your rents are too high, your expenses are too low, you don't have enough money in it. I'm like, okay, how much do you want to put in there? And then he changes the numbers for an hour, and then he comes back and goes, yeah. And I go, Bill, you just put less rent on one and more rent on the other and spread the money around. It's the same numbers. But I think that's the way he does his own sensitivity analysis. I don't even know if he knows formally what a sensitivity analysis is, but that's what he's doing. He's got to get in the spreadsheet and change all the numbers and move them up and down to see how it reacts. And then he starts to maybe feel comfortable. So you just got to let him do it.
Just got to let him do it.
That's exactly right. And I would drive people crazy. I do. The thing is, it's like a car. It's like a suit. I've got to try it on. I got to drive it. I've got to go and feel it because there are people in here. There's not mechanical things. They're people. And I know that this guy is unhappy about this and this guy's getting that kind of analysis is we really know our investment. And yes, I drive people crazy. Also, I do know what a sensitivity analysis is, but the thing is, there's a lot of numbers on the page and it doesn't communicate to me exactly. It shows me budgets and variances and this and that. How do you communicate that the rents are 3.5% off? Well, in a small building, 10 units, one unit affects 10% of the change. So That's why I don't like to buy extremely small units. I'm not saying don't, but the investors that are buying and only can afford 1, 2, 3, 4 units, when the unit's vacant and I manage it for somebody, they're panicked. It's a house of fire. I got 25% vacancy if I have a 4 unit and someone stops paying. And it's like alarm bells. And they can't do their work and they can't talk to their wife. They can't go home. They can call me. I'm in a panic. I go, that's why you hired me. I told you it's going to take a while. That's why we have a reserve. That's why it takes time. But here's the opportunity. We can get a better tenant. We can get 2 tenants instead of 1. So if somebody loses their job, you're not in this position again. Or we can actually get a little bit more money because we added a fence around the property. And that way they're going to pay us more because they're going to have a pet and they're happier and they're going to stay longer. Wow. Those are a lot of things that I just said that are really important and they're very basic. It's not rocket science. It's a lot of hard work and a lot of people doing it. And nothing frustrates me about Dwayne. He's been the best gift. I really do. I really feel that way. I don't have any criticism of him. After the show, there might be like, hey, we didn't do this or you need to do that. But no, I can't think of anything. I'm sorry offhand. This is my chance and I blew it. But I'm just so happy to
That's
have him.
okay.
He's so talented.
He is talented. Just from the short time that I've spent with you guys, like both of you together work really well. Do you want to add anything to this or are you ready to close?
I definitely have things to add. You want me to go first?
Dwayne, take it away.
Okay. So I would say people who are envisioning underwriting, if they haven't done it before, they think, okay, you work on that Excel sheet or that other thing with your calculator, because you can model a deal with a calculator and a piece of paper if you're just thorough enough. Bill used to do it. It's all about hard work and being organized. But you would imagine somebody, okay, they tweak those numbers, and then finally they get a good deal. No, the good deal is you're already there or not. You're just discovering it. So keep that in mind. Everybody says, oh, all the brokers lie and misadvertise. No, not all of them. Some I look and they have very reasonable rent assumptions and we use them. Some of them are so far off, it's just comical. So you have to look at it. They pick out comps. Some of them are great comps. Some of them are irrelevant comps. This is really just a matter of going through a process. And then that thing with the emotion is probably the biggest thing, that catch yourself all the time. Am I just hoping this is a good deal or is it really making sense? And once you've done some of them, there's a feel. You can almost tell right away. They're asking way too much for this building. Run away, at least for now. So that's what I've learned.
Bill, did you want to add anything?
Always. I'm never short for words because I love this process. I love deal finding, deal making. I'm a hunter and fisherman. Hunting at the office, fisherman by trade, but by pleasure. But the thing is, the numbers are only numbers on the page. There's a physical asset there. You've got to see it. You got to bid it out or you got to go see it. When I drive a property and I see the shingles falling off, I know there's going to be some roof work. I know there's no gutters. I know long-term, just common things on the outside. So I start putting those in my assumptions as soon as I come in. I'm like, that goes to this file. That goes to this file. Of course, I have never seen the inside because tenant owners typically don't show properties with tenants because it's just aggravation. If you show every potential owner or buyer the property, your tenants are going to move out. So you can't see the inside until you put it under contract. But one thing I want to say is if we start getting it through the underwriting and it's a deal that I have my eyes on and I like, I'm all over it. I'm all over it because if you wait analysis by paralysis, I guarantee you there's 10 people that want to take the property away because I know with my conservative approach that there's going to be at least 1 or 2 guys out there or gals that are going to want to take that property away from me. And you know what? So many times they do. You're like, why? That's not good because I'm not meant for each one. There's a little karma that goes into this. There's a little reason why we get it or why we don't. And some deals that I got really aggressive on, I've never been happier. Some deals we've bought, somebody positioned the property and flipped it in a short period of time and only did 50% of the work. I bought almost a $4 million property. Now it's worth 6+ in a short period of time, in 5 years. And that's short for real estate. And the guy did 50% and left me with the hard work. I did the hard work, but I was able to increase the value a lot. So just because it's, glass is what, half full or half empty, right? Which way you think it is. I think that we see that, and that a lot of people miss deals because they don't have the underwriting confidence, they don't have the experience, and they don't have the team. And I think that's what really helps us to make it successful for people and mitigate the pitfalls of underwriting in real estate.
So maybe you're listening to this, maybe you're watching this, maybe you've had analysis paralysis, maybe you've got money and you want to invest in real estate and you just don't know what to do. And I think maybe you started looking into it and you realized, I cannot do this alone. That is why Bill and Dwayne are here. That is what TR Wealth Management is for. So if people want to get a hold of them, you can contact them, trwealthmanagement.com. They are accessible. They have a wealth of knowledge, right? We're not just dealing with real estate, we're dealing with everything that comes with real estate. And I think that through this process, you will see that they are the experts. And they're not just experts, they have experience.com. Very easy to get a hold of. If you're thinking about it, don't suffer from analysis paralysis. Make the call. You guys got this. You guys are amazing today. Thank you so much for doing this. Thank you for having me on your panel. I love it.
Thanks, Rachel.
Thank you so much. I love your energy.